Hello everybody, welcome back. It has come to my attention that a lot of you guys are not happy that I have been consolidating pretty aggressively recently in my portfolio. As investors, we're taught to buy stocks and hold them forever, but recently I've had a bit of a different mindset change. So today I'm going to be discussing why consolidation is very important for any long-term investor, why you should never be complacent, and what I honestly think is the best move for any investor at this point. Before we get to the video, thank you to my channel members Redwood, SoFi Boy, and Jacob. On to the video.
Hello? I like money.
If you've been keeping up with the channel recently, it's no secret that I've been selling out of a lot of positions. Some really good positions and some very bad positions. But overall, I think the number one thing to kind of keep in mind is the strategy that I'm going for now. I want a very good portion of my portfolio at this point to be in ETFs or index funds. It's low risk and practically over a long-term time horizon, I'm guaranteed to get somewhere between an 8 and 12% return. I realize that picking and nitpicking individual companies and stocks is probably not the best way to go. But I still do want to be investing in some very good ideas that I have, so I'm not going to stop buying individual stocks, but I definitely do want to have a good portion of my net worth and portfolio into ETFs and index funds, such as SHG and SHD. It's a passive approach, it's hands-off, and I don't have to be worrying and keeping up with earnings reports, news on the company, CEOs going in and out, all that stuff. Frankly, guys, I don't have the time that I used to be going through all these earnings reports. I don't have the enthusiasm that I used to be going through all these earnings reports. That's why I've really been cutting down on some of these companies. And most important, it's effective. If you try and nitpick stocks, it's kind of clear that you're probably not going to outperform the S&P 500. And I'm not saying you can't, but there's not a good chance, and I think you're more likely to get a market, comparable return. I've had a lot of positions in my portfolio, about 5 or 6, that only made above like 1 or 2% of the portfolio. In the grand scheme of things, it was not that big of a deal. Why would I not concentrate that money into an index fund or ETF or a much bigger and better core position that I want to build up? It just doesn't make sense. Even if the stock were to go up another 20-30%, I'd literally only probably be making like $20 or $30. It's just not worth it. But here are 5 of the reasons that I have been selling out of some of the companies as of recently. I'm going to be giving you guys some examples as well in my portfolio. First of all, the big reason for a lot of these companies, more specifically Costco, is valuation. If I get a very good price on a company, a very good valuation, sometimes I just can't say no. And you obviously have to add that with the other circumstances in the portfolio, how big the holding is, etc. But if I see a price on a business that the market is giving that I think is a premium, especially for the growth considered, I'm 18 years old, I'm investing for 20, 30, 40, heck, even more years. Does a trash management company deserve to be trading at a 30 premium when I could buy a business like Visa for a cheaper valuation than that? Some of it just didn't make sense. I've been going heavier into my higher conviction positions such as Amazon, Visa. Visa's gotten to the point where it's the top position in my portfolio just because I've been adding so much recently. Valuation is the one thing that I really do take into consideration. If I still do believe that an asset that is undervalued or even, fair value, there's a company called Target in my portfolio right now that I've been looking to sell out of, but it's not giving me the valuation right now, and I'm fine with being patient holding on to it. A company like Costco, how much growth does realistically Costco have? Yes, obviously there's a good amount of growth to be had, but 53 PE growth, where's that coming from? I believe that a company like Costco is overvalued, and I didn't own enough where it's like I can let this ride out regardless of, the ups and downs of the market. It was only 1% of the portfolio. It's not going to compound that much. It could 3x, and I'd still have the same amount of gains that I've had for my Microsoft position that I've really built up. The second reason for a lot of these also as well is that they're small holdings. This is kind of the common theme between all of them. All these positions, as I mentioned, they are 1-2% of the portfolio, and I have not been building them up mainly because of valuation. A lot of these holdings, even if they were to 1, 2x, 3x, whatever, I wouldn't be getting that much money at the end of the day, and it would still only make up about 2-3% of the portfolio if they did. 3, opportunity cost. Opportunity cost is essentially if you see an opportunity that, it may be worth selling out of the company, even at a loss sometimes, if it's that good of an opportunity. Let's say Visa goes to $200 tomorrow. I don't know, something bad happens. That would be opportunity cost. I'd probably sell out of a company like Target and do that. 4, I've also had a big change in philosophy as of recently, as I've kind of mentioned. I'm going way towards more like a passive approach, buying some of these companies, just letting them compound. Companies like Microsoft, Visa, even my ETFs, SHG, SHD, just buying those, letting it ride out, and it's just much more hands-off approach than having to consistently keep up with these earnings reports and all that stuff. I'm definitely going towards a more ETF approach to investing. If you would have asked me a year or two about this, I would absolutely be in denial, but I think I've just grown. And lastly, circle of competency. I don't have the time anymore, as I mentioned, to be going through earnings reports. This more specifies to a company like AbbVie. AbbVie's a pharma company, and it kind of broke the second rule here. It was not a small holding. It was probably my fifth or fourth largest position in the portfolio. I owned a couple thousand worth of it, and it was a tough decision because the financials are improving. It's a solid business. I just didn't understand it. The pipeline was very hard to understand. I'm not somebody that has a crazy background in pharma and medicine. I don't understand it completely, and I had to be honest with myself. So I sold out at a gain and I put it into an ETF and Visa, a business I understand a lot better. In conclusion, you guys got to be picky with your stocks. Don't over diversify in your portfolio. Don't dig yourself into a hole like I did. Just find a really solid few businesses that you completely understand that have a long runway for growth and invest in ETFs. That's all you need to do. Alright, hope you guys appreciate the little bit of an update to my portfolio, why I've been selling out of some of these holdings recently. Smash the like button, subscribe, and do Dividend Stocks Out Drugs. Have a good one.
The reason we know how to use margin because we know how to use margin. Because you don't know how to use margin, well, don't put it on us. Don't even ask us questions.